Today, credit growth is easing. Hello again, it's Martin North from Digital Finance Analytics, our latest post covering finance and problem news with a distinctively Australian flavour. Well, over the last couple of weeks, we finally got the financial aggregates data from the RBA, that was just before Christmas, and then the credit data from APRA yesterday. So today, I'm just going to quickly walk you through the data, which shows some quite interesting trends. Credit is still growing, but the rate of growth is definitely easing. So we'll start with the financial aggregates for November, which came out on the 23rd of December. And the RBA said that total credit grew in the year to the end of November 2022 by 8.9% compared to 6.6% a year earlier. And in the month, it was up 0.5%, which was the same as October. Now, one way we can look at this is the monthly movements. So this is looking at housing over the month, up 0.41% to the end of November, of which owner occupation was 0.44% and investment lending was down to 0.29%. So you can see there there's a little bit of easing on both sides of the fence there. Personal credit was up 0.18% and is still slightly in positive territory compared with a few months ago. And business credit was down significantly, just up 0.71%, a significant drop from the last couple of months. Now, of course, these numbers in the monthly series are pretty volatile, so we shouldn't worry too much about what they're saying, but the trajectory is pretty clear. We can also look at the aggregate growth in credit, which was down 0.49%, so you can see that the trend down is now significant and pronounced. And the broad money measure is also dropping as well. That, of course, is related to lower levels of credit. And we can also look at the annualized numbers, which gives us a bit of a trend view. So housing is at 6.86% overall. Owner occupation is down to 7.34% and is continuing to slide. And investment lending is down to an annualized growth of 5.9% and again is sliding. We can see that personal credit is down a little, although we touched positive territory for the first time recently. And business credit is down. And we can also see that total credit is down to 8.88%, so that's coming back now. And broad money is also down a little at 7.41%. We can also look at the 3-month rolling because this tells you a little bit more about the most recent changes. Housing there was at 1.3% over the last 3 months on a rolling basis. Owner occupation was 1.51%, again falling. And investment lending down again at 0.87%. And you can see how, in fact, credit growth started to ease not just when rates were cut, but through the end of last year. Personal credit down a little too, and business credit down significantly. Now, we can also look at the APRA statistics, and this, of course, is for the deposit-taking institutions or banks. So the total number to bear in mind is $2.051 trillion outstanding for mortgages across Australia. That's another new record. And within that, you can see that there was growth both on the owner-occupied side of the fence and also the investment side of the fence. But net-net, the proportion of lending for investment purposes dropped again down to 38.84%, and it's consistently sliding since, well, March 2019. In the month, owner occupation amongst the banks rose 0.56%. Investment lending ticked up a little to 0.37%. And overall credit grew at 0.5%. So we're still seeing continued lending. And that, of course, includes significant amounts of refinancing, including equity drawdown. Now, the data on equity drawdown is rather fragmented, so we don't know what proportion of those new loans were actually including equity drawdown, but from our surveys we know that it's quite a significant proportion. And here is the breakdown by individual banks, split out by owner-occupied and investment lending. And I've stat ranked it by owner-occupied lending. And you can see there that Commonwealth and ANZ are the most significantly growing, according to their portfolios, with focus both on investment lending and owner-occupied lending. Westpac grew predominantly in owner-occupied lending. Macquarie had a significant share of investment lending. And at NAB, there was a fall in investment lending, but a rise in owner-occupied lending. And Bendigo, Bank of Queensland, were also lending. Interestingly, if you look over towards the right-hand side, HSBC and ING both had a reduction in their portfolio size. AMP reduced the owner-occupied lending, but were focusing on investment lending. And some of the other smaller players were also playing, but of course had a significantly smaller impact because their portfolios are slightly smaller. So here you can see the continued trends which show that the total momentum in credit lending is easing, although it's still positive at the moment, and some of that positivity is being driven predominantly by refinancing, where people are continuing to draw out further equity. And we're also seeing the slew towards owner-occupied borrowing as property investors get a bit more coy about moving into the market at the moment. And we also know, of course, that some property investors are trying to sell their properties because they want to try and get some of the capital gain that they got over the last couple of years before prices fall further. So this inflection point is quite clear now, and my expectation is over the next 2 to 3 months we will continue to see credit momentum ease back. Of course, the question will be, will we get to the point where total credit growth goes into reverse? Watch this space. It's possible, as interest rates continue to rise, that in fact momentum will turn negative. If that's the case, I expect regulators to start panicking. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.